Good morning, students. Welcome you all once again on the video revision lecture of Ind AS 12. I hope my screen is visible. Whether my screen is visible? Yes. So today we are going to revise Ind AS 12, which is on income taxes. Right? So this standard talks about accounting for income taxes. Your income tax provisions will be covered through income tax, right? Which is not the accounting part. But here we are talking about how to account for the cases where income tax provisions are applicable. I mean to say, when an entity is earning a profit or when an entity is preparing its profit and loss account, how the taxes are going to be accounted for. Like we are aware, there are two kind of taxes in terms of statement of profit and loss. What are those two kind of taxes? Shailendra and Karthik, it is current tax and deferred tax, right? So what we will do today, we will quickly revise the entire concept of Ind AS 12. I am taking you on my Excel file. Through the Excel, we will revise the entire concept of Ind AS 12, and then we will solve few questions, few complex question, detailed questions on Ind AS 12, right? Yes. So friends, in India, I hope my Excel file is visible to all of you. Yes. In India, our old accounting standard was AS 22. It is AS 22, old accounting standard. AS 22 talks about accounting for taxes on income. Then globally, it is IAS 12, International Accounting Standard 12. IAS 12 talks about while the title is income taxes, it talks about accounting for taxes on income. And in India, when we converged IFRS into Ind AS, so Ind AS are the converged IFRS applicable to India. What we did, we converged IAS 12 to Ind AS 12. That's why the title is same, income taxes. But what it talks about accounting for taxes on income, right? Friends, income taxes, like you all have seen, statement of profit and loss. In statement of profit and loss, how your statement of profit and loss structured? First of all, there is a revenue, then other income, then there is a total income. Then you have expenses, right? Employee benefit expenses, your finance cost, depreciation, amortization, other expenses. Okay. So you have the expenses. Then it will result you in giving a profit before tax. Then after profit before tax, there are two line items, current tax and deferred tax. You all have seen that P&L, na? Karthik, Salendra?
Yes, sir.
Current tax and deferred tax. And then when you deduct current tax and deferred tax, current tax and deferred tax give you total taxes. And when you deduct total taxes from profit before tax, it will give you profit after tax, which will transfer to retained earnings in your statement of changes in equity, in your reserves and surplus. Okay. So we understand income tax is equal to current tax plus deferred tax. Now, what is current tax? Current tax means a tax which has to be payable, as per the current provisions of income tax. Right? Means, how will you arrive at provision for current tax? How will you arrive at a provision for current tax? For example, there is a company which has prepared the financial statement for financial year 24-25. And this company has also prepared a statement of profit and loss, statement of P&L, right? And this company has a revenue, and instead of revenue, let me write total income. Total income, right? Then there is a total expenses. Less total income is, for example, let's say 1,000 rupees, 1,000 crore. Less total expenses. It is, let's say, 800 crores. Okay. Then your PBT is 100 minus 8,000 minus 800 crores. Now, tax expenses, less taxes or tax expense. In tax expense, there is a Provision for current tax. Instead of provision for current tax, let me write current tax. What is this current tax? How this current tax is going to be computed or calculated? What is this current tax?
Sir, current tax is computed as per IT provisions.
Very good. Current tax has to be computed as per the IT provision, income tax provision. So what this company will do, this company will prepare a computation of income. For financial year 24-25, this company will prepare the computation of income, right? And you understand how we prepare computation of income. We start with profit before tax, right? And then what we do? We disallow few items which is not allowed as per Income Tax Act. We disallow those items and we allow the item which is allowed as per Income Tax Act. For example, and the classic example is the company has invested in mutual funds. Okay. So as per Indian accounting standard, what company will do? At every reporting date, what company will do if company has purchased mutual fund for 1 crore rupees 5 years back? The cost was 1 crore rupees. Tell me what will happen in Indian accounting standards for those mutual funds? How it is going to be measured on every reporting date? Fair value. So mutual funds being a financial asset has to be measured at fair value at every reporting date. For example, in the current year, due to the increase in the Sensex, due to the spike in Sensex, the mutual fund value has gone up from 1 crore to 1.2 crore. Right? The company has not sold the mutual fund. So is it a realized profit or unrealized profit?
Unrealized profit.
Unrealized profit. 20 lakh is the unrealized profit. So this 20 lakh will come under total income, right? Mark to market on mutual fund, unrealized income on mutual fund, right? So this will become part of your profit. This will become part of your income, 20 lakh rupee of mutual fund. But what income tax provision says? In your company's books of accounts, in your company's P&L, you have accrued that unrealized income. Why? Because of Ind AS 109. Because accounting has to happen in the books of accounts as per Indian accounting standard, right? As per Ind AS. But the tax needs to be computed as per income tax provisions. So your income tax provision says that we will not account for any unrealized profit or losses, right? So this unrealized income, we don't know what is this unrealized income. So whatever income is there, please remove that income. Means you will deduct that income while preparing a computation of income as per Income Tax Act. You will reduce that income. Okay. Right. And then you will compute what will be my tax liability according to current income tax rate. And then you will arrive at a current tax provision. Okay. The second example and the classic example is depreciation. Right? For example, the company has purchased a machinery. The life of the machinery is 10 years. And the company has purchased a machinery for 10 lakh rupee. What is the depreciation per annum in the company's books? 1 lakh rupee. Right? 10 lakh divided by 10, 1 lakh rupee. So 1 lakh rupee is the depreciation as per the company's books. But Income Tax Act says that the depreciation has to be 15% on this machinery, right? So in your company's books, you have charged 1 lakh rupee depreciation to P&L. But Income Tax Act says that 15% means 15,000 rupees. Sorry, 1.5 lakh rupee. So what you will do in computation of income, you will add back whatever depreciation you have deducted in your P&L and you will deduct the depreciation as per the Income Tax Act. You will add 1 lakh rupee depreciation, you will disallow and you will allow 1.5 lakh rupee of depreciation. So this is how you prepare your computation of income. This is how you arrive at taxable income. This is how you arrive at the tax liability. And my dear friend, this is known as current tax. This is known as current tax, provision for current tax or current tax. Then the next item is deferred tax. Deferred tax, right? And then when you deduct this, for example, your current tax is, let's say, I'm just taking a hypothetical example, it's 50 rupee, and your deferred tax is, let's say, 40 rupee. So what is my PAT? What is my profit after tax? My PAT is 200 minus 50 minus 40, right? 110 will become my PAT. Okay. So friends, if I talk about this standard or even accounting standard 22, so this standard only covers 5% portion on the current tax, right? So this standard only talks about 5% on deferred on current tax, and largely 95% of the standard is around deferred taxes, right? On the deferred tax. So in this standard, what we are going to understand, learn, revise, we are going to understand recognition, measurement, presentation, and disclosure of what? Current tax and deferred tax. We'll also talk about some specific item. What are the 4 pillars of accounting standard? Karthik, this question is to you. Yes, Karthik, please.
Recognition, measurement, presentation, and disclosure.
RMPD, recognition, measurement, presentation, and disclosure, right? So when even in your interview, if the interviewer will ask how you will look at the transaction if you are joining a controllership vertical, or you are joining a technical accounting team, financial reporting team, or you are joining a top 10 firms of India in the audit department, and the interviewer will ask how you will look at a particular transaction from the compliance perspective, then you should say we will look at the recognition provision, measurement provision, presentation, and disclosure provision of that transaction in the books of accounts, right? So friends, quickly I'll take you through with this P&L while we have discussed also. This is company's books as per Ind AS, right? Year 1 and year 2. These are the 2 years, and this year 3 also, right? So for 3 years, what we have done, we have drafted a company's P&L. Revenue is 1 lakh rupee every year. Okay. Expenses, provision for gratuity. In the first year, it was 10,000. Second year, 10,000. There was no provision for gratuity in the third year. Employee benefit expense, 20, 20, 20. Other expenses, 30, 30, 30. Total expenses is how much? How much is your total expenses? 60,000, 60,000, and 50,000. Okay. What is your profit before tax? 1 lakh minus 60, 1 lakh minus 60, 1 lakh minus 50. Okay. So 50,000, 40, 40. Tax expense. Now, what is my tax expense? Okay. How will I compute my tax expense? So first, let's go to the year 1. In year 1, what we will do? What is your profit before tax? What is your profit before tax? In year 1, it is 40,000, but
40,000.
But let's say if I will prepare a P&L under Income Tax Act, right? Like you are preparing your profit and loss as per the Companies Act. Companies Act के according ही करते हैं ना? We are preparing our financial statement as per Companies Act or as per Ind AS?
Companies Act.
Both, sir.
Ind AS also. Ind AS compliance companies will prepare as per Ind AS.
So Ind AS are the part and parcel of Companies Act only. Ind AS are notified under section 133 of Companies Act. Right. So if somebody
Yes.
will give you a question, that are you living in your house or your parents' house? What is the most appropriate answer? Given you have given only two choices. So what is the most appropriate choice? Parents' house, right?
Parents.
So if somebody will tell you, are you preparing your financial statement as per Companies Act or as per Ind AS? So Companies Act includes Ind AS, right? So you should say Companies Act because it includes Ind AS, right? So Ind AS are notified under Companies Ind AS Rules 2015 and under Section 133. Okay. So if I will prepare my profit and loss as per income tax provision, not Companies Act provision, income tax provision. So how will I prepare my P&L? My revenue will be 1 lakh rupee only. This is my revenue, right? So now this provision for gratuity, will it come under income tax P&L?
No, sir.
No, sir.
It will not come. It will not come. Why? Income tax
No, sir. These
officer.
are provision only. It will not come.
It's a provision only. Income tax officer said that I don't know income. I don't know Indian accounting standard. I am not a CA. So income tax officer says that I only knows what you have actually paid for gratuity, what provision you made, what is actuarial valuation, I don't know. So income tax officer, while preparing the profit and loss, income tax officer says that I don't know gratuity, this provision for gratuity मुझे नहीं पता, right? So zero. Then employee benefit expenses and other expenses, of course he will consider employee benefit expenses and other expenses, and what it will become, it will become the expenses in the income tax P&L. And in income tax, what is your profit? 50,000. In company's books, what was the profit for the first year? 40,000. 40,000. So in your company's books, as per Companies Act, profit was 40,000. In income tax books, in Income Tax Act, the profit is 50,000. Assuming tax rate is 30%, how much tax you are liable to pay? 50 multiplied by 30%, 15,000, 15,000 rupees. 50,000 multiplied by 30%. Okay. My dear friends, tell me one thing. Tell me one thing. What is your provision for current tax in this case?
15,000.
15,000, of course. So you earned 40,000, but you are paying a tax on 50,000. Means you are paying tax on higher profits, higher income, right? So this provision for gratuity, which Income Tax Act has disallowed, will it allowed at a later stage?
Yes, when it is paid.
When it is paid. Yes, when it is paid. So my question is, if my provision for current tax is 15,000 rupees, in the current year, I am paying a tax liability at a higher income, right? Higher taxable income. So will I get any benefit in future?
When it is paid, you have to pay lower taxes.
Yes, while this provision pertains to year 1, but it is disallowed in Income Tax Act, and that is why I have paid a higher taxes in future. When this liability is getting paid, when this gratuity is getting paid, the Income Tax Act, the Income Tax Department will give you an allowance in that year in which it is paid. While in companies' books, this expense will not be there. But in Income Tax Act, this expense will be there. For example, assuming this provision for gratuity, which we have debited in year 1 and year 2, has been paid in year 3. You can see there is no expense in the year 3. But when I prepare my computation of income as per Income Tax Act, when the income tax officer is preparing, what he has done, he has debited payment for gratuity in the P&L. Why? Because he has considered the actual payment amount, actual paid amount. So you can see this 20,000 which was debited in the company's P&L in year 1 and year 2 is getting allowed in year 3 in Income Tax Act, right? So this 10,000 in company's books, it was in year 1 and year 2, but in income tax, it is not there. But at the same time, in year 3, there is no expense for gratuity. But in Income Tax Act, there is a 20,000 payment for gratuity expense, right? It means the higher taxes which I am paying today, I will get a benefit in future. So what should I create? In addition to current tax, what should I create also?
DTA.
Deferred tax. And when I say deferred tax, is it a DT or DTL?
It can be anything.
Yes, it can be
DTA.
anything. It could be DTA or DTL. But in this situation, will it be DTA or DTL?
DTA.
See, if you are paying higher taxes today, Lavanya, if you are paying higher taxes today, means what? You have to pay less taxes in future.
Yes, sir.
Yeah. So
Yes, sir.
you have paid higher taxes today. That is why you will pay less tax in future. It means,
Yes,
it means you have paid in advance. यही
yes, sir.
मतलब है ना इसका.
Yes,
It
sir.
means it will create an asset for you.
Yes, sir.
That is why you are getting benefit in future, na? What is the definition of asset? Asset is a resource controlled by an entity which gives you future economic benefits. What is a liability? Liability is an obligation to pay in future, right? So if
Yes,
you will get some benefit in future, why you will get some benefit? Because you have done some investment, you have created some asset. That is why you will get the benefit in future, right? So it means it will create a deferred tax asset. At what value we will create a deferred tax asset? So we have already created a provision for current tax at the rate of 30% for 15,000 rupees. At what value DTA will be created?
the difference between the taxes at 30%.
Yes, the difference between the taxable profit and the accounting profit, or and what is the difference between the taxable profit and accounting profit? The difference can be of two types: temporary
Taxable
difference
temporary difference, deductible
and
temporary difference.
permanent difference. Temporary differences and permanent differences. So, what is the difference between a temporary difference and permanent difference?
So temporary difference, it relates to 1 year period. Permanent differences which cannot be reversed.
So, permanent difference, you are absolutely right, Lavanya. Permanent difference means a difference which is a permanent in nature. It is never going to be reversed, right? No benefit will flow in future, right? No benefit, no liability will flow in future. It's a permanent difference. What is a temporary difference? A difference which is temporary in nature. It will going to be reversed in future, not 1 year. It's not 1 year, Lavanya. It can be 2 year, 3 year,
Okay.
4 year after also, right? Which has a potential for reversal. So that is why the word is temporary. That is why the word is temporary. It is not timing difference. It is temporary difference. Okay. So in this case, this 10,000 rupees payment provision for gratuity has created a temporary difference, which is going to be reversed in year 3 when the company will pay the gratuity. Okay. So 10,000 multiplied by 30%. 10,000 multiplied by 30%. 3,000 rupee will be your deferred tax asset. What is the accounting entry? What is the accounting entry? What is
DTA debit to
the
P&L.
accounting entry? If you will create an asset, deferred tax asset account debit, credit, credit, provision for
Provision
deferred
for
tax,
tax.
right? Credit deferred tax income. So deferred tax asset debit to deferred tax income. So this is how your accounting has to happen. Your current tax expense is 15,000. In your deferred tax, there is an income of 3,000 and it is 12,000, right? And practically, how will you ensure that your working is right? How will you ensure that your working is right? You need to check your effective tax rate, ETR. What is ETR? Your total tax expense should be profit before tax multiplied by effective tax rate. What is tax rate? What is tax rate in this case? In year 1, what was the tax rate? Prevailing tax rate क्या था? 30%.
30%.
30%.
So if I will multiply this profit before tax multiply by the tax rate, my total tax expense should be 12,000. So my profit, accounting profit before tax is 40,000. What is my tax rate? 30%. What is 40,000 multiplied by 30%?
12,000.
12,000. Can I see 12,000 here? Yes, 12,000
Yes.
is there. 15 minus 3, 12,000. It means my equation is right. Okay. And this is my profit after tax. Is that clear?
Yes, sir.
If there would have been a permanent difference, for example, the company has paid a donation, charity and donation. The company has done a contribution in CSR. And you understand, for donation, the company will get a benefit under section 80G. 80, 80G,
G, sir.
na?
Yes, sir.
Yes, sir.
80G. So why it is 80G? G stands for good and God.
God.
So when you are donating, what you are doing? You are doing charity. When you are donating, you are doing a good cause. So 80G, G stands for good and God. So that is why 80G is for donation. Right. So if the company has done some expenses on account of charity and donation, right? Of course, the company will debit into the P&L. Yes or no? It's an expense for the company. In the company books, खर्चा आएगा नहीं आएगा? आएगा. Lavanya, whether the expense will be there or not there? The
Yes, sir.
expense
Will
will
be
be
there,
the
sir.
expense will be there, right? In the
Yes, sir.
company's books. But if the company has applied the lower tax rate, the 25% tax rate, whether this expense on CSR, charity, donation is allowable? No.
No, sir.
If the company has opted for a lower tax rate, these deductions are not allowed. So tell me, in this case, when you prepare in your accounting books, in your accounting P&L, the expense on account of CSR, charity, donation is there. But when you prepare your income tax computation as per provision for Income Tax Act, whether this expense will be disallowed or not disallowed?
Disallowed, sir.
Disallowed. And Karthik, this expense which is disallowed in the current year, will it going to be reversed in future year?
No, sir, it's a permanent difference.
It's a permanent difference. It's a permanent difference. So on the permanent difference, no deferred tax will be created, right? Because it does not have a potential of reversal. Deferred tax is created only on the temporary differences, only on the temporary differences. Okay, right? So here you can see in the current year, the current tax is 15, the deferred tax is 3, the total tax is 12,000. In the second year, the same thing is there because this is exactly cut, copy, paste P&L. What happens in the third year? In the third year, your profit is 50,000, accounting profit. But your tax profit is how much? Your tax profit is 30,000 only. Your current tax provision is 9,000 only, right? So current tax provision in year 3 is 9,000. So what about deferred tax? Whatever deferred tax you have created, deferred tax income you have created, now you will reverse that income, right? So this will be reversed. So total tax expense will be 50,000, 15,000, and it is matching with this equation also. 50,000 multiplied by 30%, 15,000, right? And this is your PAT, profit after tax. Any question here? Any question? Have you understood it very well? Yeah,
Yes, sir, no questions.
right? So this is what the accounting entries are there. Provision for current tax expense account debit to provision for current liability account. Provision for current tax liability account. Current tax liability account. Deferred tax asset to deferred tax expense. In the third year, it will be reversed. Deferred tax expense account debit to deferred tax asset account. Okay. So talking about the current tax concept, current tax has to be computed as per the income tax provisions. Accounting entry of current tax will be provision for current tax expense to provision for current tax liability. When you pay advance tax, what is the accounting entry? Advance tax asset account debit to bank account. Okay. In balance sheet, advance tax and TDS needs to be netted off from provision of current tax liability. The netting has to be year wise only. For example, for the last year, your advance tax and TDS was higher than your provision for current tax, okay, in the last year. Means you have an income tax refund. In the current year, there is a provision for tax liability at the when the company is preparing the P&L, when the company is preparing the balance sheet, at the end of the year, the company has a provision for current tax liability. So can I offset my last year receivable, income tax receivable with the current year payable?
No, sir.
No. The netting, the offsetting, the netting has to be year wise only, right? In a particular year, if there is a provision for tax liability and there is a advance tax and TDS, it can be netted off, right? But it cannot be in the different year, right? Now we reach to the deferred tax concept, right? We covered the current tax provision concept. Now we reach the deferred tax concept. And what is meant by deferred tax? A tax which is going to be deferred, right? Deferred means postponed. A tax which is going to be postponed, right? Either the recovery of that tax or the obligation of the tax. Means either tax liability is deferred or the tax recoverability is deferred, right? That is why it is known as a deferred tax. Deferred tax is a tax payable or recoverable in future periods. What is the point to remember? And let me ask you a question here. Okay. A company has prepared a financial statement for the year ended 31st March 2025. Okay. 31st March 2025. And when the company has prepared the the financial statement, so on the balance sheet date, the company was having a huge losses, right? The company was having huge losses. So it was a private limited company, while the company was applying Indian accounting standard because the net worth is more than 250 crores. So for the private limited company, what is the due date of submission of financial statement to ROC, to MCA? What is the due date? I mean to say, by when the financial statement needs to be audited and closed?
30th September was it, sir?
30th September.
30th September. And what about listed companies? For what is the date for the listed company? For the listed company, it is 31st March. 31st May. 31st May. For listed company, the result has to be published by 31st May. Means 2 months. So for listed company, 2 months. For unlisted company, 6 months. Okay. So you are the chartered accountant. Let's say, Karthik, you are the chartered accountant. You are the auditor of that company. So on 31st March, when the company prepared the financial statement, so for 31st March, there was a huge losses in the P&L. And this financial statement, was closed by September. These financial statements were audited by September. Karthik was auditing those financial statements. So in the 6th month, while up to 31st March there was losses, but in the 6th month, the company got huge orders at a high inflated price. The company got huge orders. Now, my question is, question number 1. For the 31st March 2025 financial statement, there is a losses in the P&L. So Karthik, will you prepare a deferred tax asset on the carry forward losses? Will you recognize deferred tax asset or not, Karthik? That is my question.
Not really sure, sir.
So on carry forward losses, so Karthik, tell me one thing. On carry forward losses, if there are losses which are going to be carried forward, will you get a benefit of these losses in future under income tax provisions?
Yes, sir.
Yes. 8 years, you can carry forward and set off the losses for a period of 8 years. So let's say, Karthik, in the current year, when you are the auditor, the company has a loss of 100 crore rupees. What happens in the next year? And of course, if it is 100 crore rupees of losses, the company is not required to pay any taxes, right? Because it's into losses. In
Yes.
taxability, it's a taxable loss. But in the next year, the company has earned a profit of 150 crore, assuming the taxable profit is also 150 crore. So, Karthik, in the next year, the company will pay a tax on 150 crore or 150 crore minus 100 crore carry forward and set off 100 crore carry forward losses, and then 50 crore is the income on which the company has to pay tax. What will be the situation? 150 or
So
50?
the income after setting off, that is
Income
50
after
crores.
setting off. It means, Karthik, you are saying that the losses which I have incurred in the current year, I will get a benefit in future when the company will earn profit, right?
Yes, sir. Yes, right.
And of course, you need to look at, is there any probability that the company will earn profit, right? वो
Yes.
देखना पड़ता है ना. मान
Yes.
लो, लेट्स से इन 8 years, अगर 8 साल में कंपनी ने कभी प्रॉफिट अर्न ही नहीं किया, इन 8 years there is no probability of the company to earn profit. Will you create a deferred tax asset on that carry forward losses?
No,
No,
sir. There are no
because
possibility of set-off.
there is no possibility of reversal. That is why income tax acts, that is why income tax is standard. Ind AS 12 says that deferred tax needs to be created on the basis of probability. On the basis of probability, right? So when it is probable, then you need to create a deferred tax asset. Probability of reversal, right? So Karthik, you are the auditor of this company and the company has a losses. But while you are signing the audit report, while you are signing the financial statement, you know the company has got huge order, and you know the company will have a windfall profit in this year. So Karthik, whatever deferred tax asset you will create on the unrealized on the losses, on the carry forward losses, it is going to be reversed in the current year only. Current year, I mean to say the next year, right? For
Yes.
example, 2025, 26. You are
Yes.
closing the books of accounts for 24,
25.
25, and you know half year has already gone. When I'll come on 31st March 26, I know that this deferred tax asset will be reversed. Now, Karthik, my question to you is the DTA which the client has created on 31st March 2025, whether it should be a current asset or it should be a non-current asset.
Sir, it will be a non-current asset. It is
Why?
specifically mentioned. So it is specifically mentioned in the standard that DTA and DTL will be always non-current.
In which standard? Where it is mentioned?
Sir, I am not remembering the para number exactly, but
No,
it
no, no,
is
not
mentioned in
para,
Ind AS 12.
not para number, Karthik. I am asking which standard.
Sir, Ind AS 12.
It is written in para
Sir,
number
Ind AS
56.
1.
Sorry, Ind AS.
Ind AS 1.
You are absolutely right, Lavanya. Para number 56 of Ind AS 1. So para 56 of Ind AS 1 says that, and you are absolutely bang on, Karthik. So para 56 of Ind AS 1 says that DT and DTL has always been non-current. So para 56 says that DT and DTL should always be a non-current asset and non-current liability. Right? And this deferred tax asset and liability shall never be discounted. For example, the question will confuse you. The question will say that the company has created a deferred tax asset because the examiner is aware these small kids who are appearing for CA final, these bacche has spent a lot of time in Ind AS 109. Yes, on the discounting, amortization, discounting, right? In income, in Ind AS, there are a lot of provision on discounting. So you know what your question will talk about the deferred. The question will say the company has created a deferred tax asset of 20 crores and the company expect the recovery of this DTA after 6 years. And the question will give you a discount rate also 10%. Tell me, After 6 years, you will be getting the recovery of this deferred tax asset which you created today or which you are going to create today. What you will do? You will do the discounting of 20 crore which is recoverable after 6 years. Will
No,
you do
sir.
the discounting?
No, sir.
No. DTA, DTL are not the monetary item. DTA, DTL are not the financial asset or financial liability. It is never going to be discounted. Right? Always remember the examiner and the interviewer both will test you. Right? Deferred tax has to be computed on the balance sheet approach. What is meant by P&L approach? What is meant by balance sheet approach? Have you heard about the word balance sheet approach?
यस सर, बैलेंस शीट अप्रोच में हम टैक्स बेस में क्या बैलेंस रहेगा और हमारे अकाउंट्स में क्या बैलेंस है उसके बेसिस पे डेफर्ड टैक्स क्रिएट करते हैं। और पीएनएल अप्रोच में जैसे अभी हमने ऊपर एग्जांपल में किया कि हमने एक्सपेंसेस के बेसिस पे जज किया कि क्या प्रॉफिट्स हैं हमारे और आगे चल के क्या प्रॉफिट्स होंगे, उसके बेसिस पे हम
Yes.
बनाते हैं।
You are absolutely right, Karthik. Balance sheet approach means the approach which you are using. You are computing your DTA DTL by comparing the balances in the company's books and the tax books. Right. For example, the company has purchased a machinery for rupees 1 lakh on 1st April 2025. Tell me, if Karthik, you will prepare your books of accounts as per Companies Act, as per Indian accounting standard. What accounting entry you will pass on 1st April 2025?
प्लांट एंड मशीनरी टू बैंक।
Plant and machinery to bank, PPE to bank, right? You are also preparing a second set of books, which is books as per Income Tax Act. What accounting entry you will pass on 1st April 2025?
सर सेम एंट्री।
Same entry. Very good. Same accounting entry. Same accounting entry. Same entry. Right. So when you are preparing a balance sheet, balance sheet as per Ind AS and balance sheet as per income tax provisions. Right. So balance sheet as per Income Tax Act, balance sheet as per Ind AS. I am preparing my balance sheet as on 1st April. I am preparing a 1-day balance sheet 2025. Can I prepare a 1-day balance sheet? Can I prepare a 1-day balance sheet?
Yes, sir.
Why
When
not? You can
PP
pay, you can
income.
you can prepare everyday balance sheet. Yes, why not?
Yes.
So see how your books of accounts are maintained. The the first level is journal entry, right? Even you're using Tally, Busy, ERP, SAP, Oracle, right? So what you do, you pass an accounting entry. That accounting entry will flow into the ledger balances. That ledger balances will flow into the trial balance. और ट्रायल बैलेंस में क्या होता है? ट्रायल बैलेंसेस में एसेट, लायबिलिटी, इनकम, एक्सपेंस द बैलेंसेस ही तो होते हैं, राइट? सो यू प्रिपेयर योर बुक्स ऑफ अकाउंट्स थ्रू ट्रायल बैलेंस ना, right? So you can prepare everyday balance sheet. So PP, what is the value of PP under Income Tax Act and Ind AS? 1 lakh. As Karthik said, the same amount, right? Very good. 1 lakh, 1 lakh. Very good. So do you find any difference Am I audible now?
Yes, sir.
Sorry, there was a power cut. Yes. Yeah. So, Karthik, have you found any difference on 1st April 2025 in the balances comparing to companies' books and the income tax books?
No, sir.
No, there is no difference. So, difference. 0. Now, now Lavanya, I am again preparing a balance sheet. On 31st March 2026. 31st March 2026. Now, Lavanya, what I'll do? If I'll prepare my balance sheet on 31st March 2026, what I'll do?
Provide for depreciation.
I'll create a provision for depreciation. I'll create a depreciation. So, right? So PP, assuming the life of the PP, this machinery is 10 years. What is the depreciation? What is the
10,000.
1 lakh minus 10,000, 90,000, right? 1 lakh minus 10,000. Under Income Tax Act, the tax rate is 15%. What is the balance which will come on 31st March 26? What will be the balance under income tax
85,000.
provision? Sorry,
85,000.
85,000 minus 85,000 minus 15,000. Sorry, 85,000. Is there any difference between these two?
Yes, sir. 5,000.
5,000 is the difference. So why there is a 5,000 rupees of difference?
Because of the difference in allowance of depreciation.
Because of the difference in the allowance of depreciation. If I would have gone by the P&L approach, I would have compared 10,000 versus 15,000. Right? This is the P&L approach. Right, Karthik?
Sir.
I would have said that 10,000 will be disallowed and 15,000 will be allowed. But here, what I'm comparing, I'm comparing the balance under company's books, which is 90,000, with the balance under Income Tax Act, which is 85,000. So I am comparing the balances. I am comparing the book base with the tax base. Book base means carrying amount. Book base means the balance sheet, the asset and liability as per the books of accounts versus the asset and liability as per income tax provisions, right? I am comparing book base versus tax base. This is known as a balance sheet approach. Now, how will you finalize? We understood 5,000 rupees is the difference. But whether on this 5,000 rupee, DTA will be created or DTL will be created. The tax rate is 30%. Tell me, 1,500 rupee will be DTA or DTL?
DTL, sir.
DTL, sir.
DTL. Why it is DTL?
We have to reduce the book base because it is higher than tax base.
Because you have taken an extra allowance in income tax, right? When you have taken an extra allowance in income tax means in the current year, you have paid lower taxes, right? In the books, you charge depreciation of 10,000 only, but in the textbooks, you charge 15,000 rupees of depreciation. Means you charge higher expenses. If you charge higher expenses in the current year, it means in the future year you are going to pay
Less tax.
higher taxes. So if you have charged higher depreciation today, you paid less tax. In future, you will pay higher tax. Right?
Yes, sir. Yes.
Sir, in examination, can you help me with a quick trick? Do you know the hand trick which I have taken in the complete class? Are you aware about the hand trick?
Yes, sir.
You are aware?
Yes, sir.
Sailendra, are you aware? Karthik, are you aware about the hand trick?
Yes, sir. You only taught us, sir.
Okay. Yes. So let me again tell all of you quickly, because many students who have not attended the full class, They must be listening or watching this video lecture. So in one hand, you are sitting in an examination, and believe me, if the question on Ind AS 12 will come, I can guarantee you, you will find a lot of students who are using this, who are doing like that, right? So in one hand, you will take a company's books, which is known as a book base. What is your book base of this PP? 90,000.
90,000.
In the other hand, you should take income tax base. So one hand is companies act, the second hand is income tax act. So your book base is 90,000, your tax base is 85,000. So your tax base is lower than your book base. Okay, 85,000. Now I need to align my books and tax. I need to align my books and tax. So for aligning my book base and the tax base, for aligning my books and textbooks, I have to pass some adjustment entry in my books, right? So if I have to pass the adjustment entry in my books, what does it mean? What does it mean? It means I have 90,000 rupees asset in my books, 85,000 rupee asset in my tax. So I need to reduce my asset balance, right? I need to reduce my asset balance. If I need to reduce my asset balance, what should I do? I need to reverse my asset. If I need to reverse my asset, what does it mean? It means I need to create a liability.
Liability.
I need to create a liability. So in this case, what is the nature of difference? The nature of difference will be liability. DTL. DTL. Okay. So this hand trick will always give you right answer. Always. Always give you a right answer. Second example, let's take. Your books. Investment in mutual fund. You have invested 1 crore rupee in mutual fund. The closing balance of the mutual fund in the books of account is 1.2 crore because of the increase in NAV, right? Because of unrealized profit. Your mutual fund balance in the books is 1.2 crore. Your income tax balance is only cost, which is 1 crore. What should you do? You have to reduce your investment, means you have to reduce your asset. When you have to reduce your asset, means you have to create a
Liability.
So they on this 20 lakhs, what is going to be created? Deferred tax liability.
Deferred tax liability.
Deferred tax liability, right? 1.2 crore minus 1 crore, 20 lakh. 20 lakh multiplied by 30%. Yes? Okay. I am audible now?
Yes,
Yes,
sir.
sir.
Yeah. So friends, you understand P&L approach, you understand the balance sheet approach now, right? So I've just covered the question in my full class, right? That like this is the example of accounting profit, taxable profit, okay? So this is the P&L approach where you are comparing your P&L items, okay? This is your P&L approach, okay? And what is balance sheet approach? Like I just shown you, okay? So your balance sheet approach means balance sheet as per company's books, balance sheet as per income tax provision. Like what you did, your gross block is 1 lakh, depreciation is 10,000, 90,000 is your closing balance. Here 85,000 is your closing balance. This is known as a tax base. This is known as a carrying amount. Carrying amount, or it is also known as a book base also. You're right. Your carrying amount is 90,000, tax base is 85,000, temporary difference is 5,000. Tax rate is 30%, DTL is 1500, right? And you need to use the hand trick to identify DTA and DTL, right? Okay. So now, what are the steps of deferred tax? What are the steps of deferred tax? Step number 1, compute the carrying amount of assets and liabilities. How will you compute the carrying amount of assets and liabilities? For example, it is PP&E. What you will do? You have to charge
Depreciation.
depreciation and look for impairment losses also,
Impairment loss.
right? because the formula of carrying amount under Ind AS 16 and Ind AS 38 and Ind AS 40 is equal to carrying amount is equal to cost minus accumulated depreciation minus accumulated impairment losses, right? So this is there. Number two, you as per Income Tax Act, of course, as per Income Tax Act also, if it is a PPNE, you need to reduce your depreciation, you need to charge your depreciation. So first of all, you have to compute the carrying amount as per Income Tax Act and as per Companies Act. I mean to say, you have to compute book base and the tax base. Okay. So compute the carrying amount of assets and liability, then compute the tax base of assets and liability. Means the first one is as per Ind AS, the second one is as per Income Tax Act. Okay, right? Step number 3. Compute temporary difference, taxable temporary differences and deductible temporary differences. Right? There are two type of differences. What are the two type of differences? What are the two type of differences in Ind AS 12?
Taxable temporary difference, deductible temporary.
Wrong.
Temporary and permanent.
Temporary and permanent. My question was not what are the two type of temporary difference. My question was what are the two type of differences. Temporary differences and permanent differences. Now I am asking a second question. What are the types of the temporary differences?
Taxable and deductible.
Taxable and deductible. Taxable temporary difference and deductible temporary differences. So moral of the story here is, right? So don't answer what you always look at, right? So in your examination question also, your Ind AS 12 question may not be straightforward. For example, a question which includes your Ind AS 16 application, PPNE application, Ind AS 36 impairment of asset application, and there the question will also test you on the applicability of Ind AS 12 also. For example, impairment of asset. If there is any impairment loss, of course, impairment loss is not allowed in Income Tax Act. So on that impairment stuff, what you need to do? On the impairment stuff, you need to create a deferred tax asset or deferred tax liability, whatever it may be, right? DTA or DTL. Okay. So the question may ask you, after giving some data, some information, the question will ask you, what is the profit which is carried to the retained earnings? The question has given you a simple line. What is the profit which needs to be carried to the retained earnings? My dear friends, if the question is asking about the profit computation which needs to be carried to the retained earning, the question is asking you profit after tax or profit before tax?
After tax.
Profit after tax.
After tax.
If the question is asking you profit after tax, means what is the intention of the question? The question,
We need to provide.
the examiner wants to know your knowledge on tax provision. Tax provision, I mean to say the accounting provision relating to taxes. Okay, right? So that he wants to know not only profit before tax, your depreciation, impairment loss will give you the profit before tax, right? But what is the impact on the depreciation and impairment, right? You need to also factor in your current tax and deferred tax. Of course, examiner will give you data, right? So whatever data is available, you need to compute your current tax or deferred tax. Okay. So then you will compute your profit after tax and that will be your final answer. Okay. What two things are certain in life? What two things are certain in life? Death and taxes are certain in life. Death and taxes. These two things are certain in life, right? So this tax is a concept which goes everywhere, right? On every line item, there is the implication of tax. The question is asking you, the investment property. Okay. And see what question which came. In your ACCA, have you heard about ACCA? It's in a course, right? In your ACCA examination, ACCA London examination, a question came, right? The question was on investment property. The question came that the company has purchased a building which is held for rental purposes. The company is earning rental from that building, and the company has purchased a building for 20 crore rupees. Okay. The company has purchased a building for 20 crore rupees, and the life of the building is 20 years. In income tax, the life of the building is 20 years. In Income Tax Act or under income tax provisions, this building, the depreciation on the building can be charged at the rate of 15% per annum. Okay. And the ask of the question is, please advise, considering the given information, please advise the presentation of retained earnings and the presentation of this asset into the balance sheet and implication of these items in the balance sheet and P&L. What this question is asking? The question is asking the balance sheet and P&L presentation and implication, right? Given the data of this building. So what information you got? Question. So Lavanya, have you understood the question? Karthik, Lavanya, and Rajat, Selindra, have you understood the question or not?
Yes, sir.
You
Yes,
understood
sir.
the question, na? So question is talking about building. The cost of the building is how much? 20 crores. What is the life of the building? Life is 20 years, right? And the building, what is the purpose of this building? Purpose of building was earning rental. Some depreciation as per income tax is also given, na? As per IT Act. What is the depreciation as per IT Act? 15%. Okay. Question is asking you impact of the above items in financial statement, right? Impact and presentation. And presentation of the above item in the financial statement at the end of the year. What should I do here? Tell me, what should I do? Lavanya, how should I approach this question? Tell me. Very simple, very small question. And this question is part of a case study. How should I approach it?
Is there any tax rate also?
Yeah, let's say tax rate is also given in the question. Tax rate 30%. Yeah, I don't know how to
We need
approach this
to
question. Can you guys help me? Yeah, Lavanya.
we need to calculate depreciation as per income tax and as per book base.
First
We,
of all, what is the nature of which Ind AS I should apply? Which Ind AS is applicable in this question? Please tell me.
sir,
India's 40 and 12.
India's 40 investment property.
What is my applicable Ind AS? My applicable Ind AS is Ind AS 40 and Ind AS 12. Okay.
12.
And Ind AS 1. Why Ind AS 1?
Presentation, sir.
Presentation. Ind AS 1 talks about presentation of financial statements. Okay. So first of all, yes, Ind AS 40 because the purpose is given as rental, right? So which means this is an investment property. And categorically, this question is asking about the presentation. You must say, sir, how does it make a difference? Be it a PPE or be it an investment property, sir, the depreciation will go to the depreciation, right? So this 15%, 20-year is given, the amount will be same, everything will be same. How does it make a difference? It make a difference where? In the balance sheet presentation, it make a difference, right? In balance sheet, might be your number may be right, but instead of investment property, if you write PP&E, examiner will cross your marks, deduct your marks, right? Understood? Understood? Right? So in this
Yes.
case, first of all, we will prepare a balance sheet. Okay. In balance sheet, what should I do? In my balance sheet, what should I do? In balance sheet, first of all, asset side, assets. Then after assets, non-current assets, non-current assets. After non-current asset, which item? कौन सी आइटम होगी नॉन करंट एसेट्स के बाद?
Current assets. DTA,
नॉन करंट
DTL, and then
in investment property. Investment property. Right. What is the value of the investment property? 20 crores minus. So investment property, your gross block. Well, how much is your gross block? 20 crore is your gross block, right? Minus depreciation is 2 crores. So amount in crores. 18 crores, right? Then your deferred tax implication also, na? Your deferred tax implication also. What is your deferred tax implication? So what is the book base at the end of the, what is the carrying amount at the end of the first year? 18 crore. What is the tax base at the end of the first year? क्या होगा tax base? 20 crore multiplied by 15% depreciation. So 3 crore. What is the tax base? 20 minus 3, 17 crore. 18 crore is book base, 17 crore is tax base. What should I do? What should I do? Can you tell me quickly?
DTL, sir.
So I should reduce my asset. Means I have to create my DTL. So
Sir,
non-current, then my, sorry,
life 20 years, no, sir.
yes.
Then
Oh,
depreciation will
I'm so sorry.
1.
So let's make this life as a 10-year. Is it okay now?
Yes, sir.
Okay. So equity, then my equity, then my, so the asset side, liability side, liability. Equity, non-current liability, non-current liability. In my non-current liability, which line item? Deferred tax
Liability.
line. And what is my deferred tax liability? What is my difference? My book base 18 crore, my tax base 17 crore. What is the difference between book base and tax base? 1 crore. 1 crore, right? What is my temporary difference is 1 crore. Tax rate is 30%. So 1 crore multiplied by 30%, how much?
30 lakh.
30 lakh. So 0.3 crores. 0.3 crore deferred tax liability. Okay. Then what next? Then I need to prepare a P&L also. I need to prepare a P&L also, correct? P&L भी बनाना पड़ेगा ना? Profit and loss. Profit and loss. In your profit and loss, there is a total income. Total income, don't know. There is a total expense, and in expense, you have a depreciation expense. How much is the depreciation expense?
2 crores.
2 crore is the depreciation expense, right? Then your PBT, assuming, since the question income is not given, so assuming this PBT is this minus this, right? Then your tax expense. Okay. So you can write, we are assuming, since in absence of the information given in the question, we are assuming income to be 0. right? Then tax expense. What is my tax expense? Current tax, not aware. Don't know current tax, right? Deferred tax. How much is your deferred tax? 0.3. 0.3 है ना?
Yes.
This is my deferred tax income or expense? You have created a liability.
Expense.
Expense.
Whenever there is an asset, there is an income. Whenever there is a liability, there is an expense. Deferred tax expense. So minus 0.3. Okay. Minus 0.3. Okay. So what is your PAT? Your PAT is this plus this. 2.3. Correct? So under equity, right? There are two aspects under equity. Your equity share capital and your equity share capital and under equity share capital, which you are not aware, and your other equity. In other equity, your retained earning will be there, right? Your retained earnings. What is your retained earnings? 2.3. This is your presentation. This is your impact. This is your impact of this question. Any question in this question? Any question on this question?
No, sir.
Lavanya?
No, sir.
Sailendra?
No, clear, sir. Thank you, sir.
Okay. So have you understood? The question seems pretty small, but when it comes into the package, right, under the case study, when it is taking the implication, you will not be able to answer this question at times, right? People make mistake. So my point is, if you are very confident and if you are aware about the concepts, doesn't matter how tricky the question is, you will be able to answer this question, right? Clear? Is that clear? Okay. So
Yes, sir.
moving further, the step number one is to compute the carrying amount, compute the book base of assets and liability as per the provision of Indian accounting standard, as per the provision of Ind AS, right? And the second step is you need to compute the value of the asset and liability as per tax provision, right? The third one is you need to compute the temporary difference. You need to compute the temporary difference, right? Either it could be a taxable temporary differences or it could be a deductible temporary differences. What is meant by taxable temporary difference and the deductible temporary difference? Taxable means,
Taxable refers to deferred tax liability and deductible refers to DTA.
so Karthik, that is an outcome. If it is a taxable temporary differences, it leads to create a deferred tax liability. If it is a deductible temporary differences, it leads to creation of a deferred tax asset. But how will you conclude that if it is a taxable temporary differences, it will lead to your deferred tax liability? It will be a deferred tax liability. See, as the name suggests, taxable temporary differences means those temporary differences which will be taxable in future. क्या मतलब है इसका, जो फ्यूचर में टैक्सेबल होंगे, क्या मतलब है? क्या होगा फ्यूचर में टैक्सेबल होंगे तो? I have to pay tax in future. I am saying you that I am saying you, Karthik, you are an SSC. You are an SSC, income tax SSC. You have to file your income tax return. I am giving you 100 rupee. This 100 rupee is your income. I am giving you 100 rupee. And I am saying, I am the income tax act. I am giving you 100 rupee. I am saying, Karthik, please take 100 rupee. Karthik, what accounting entry you will pass?
So cash to income.
Cash to income. Very good. Simple cash to income. You will pass an accounting entry, cash to income. So Karthik will pass an accounting entry, cash to income. And I am income tax act, Karthik, I am saying that Karthik, this 100 rupee will be taxable after 5 years. upon meeting some certain condition, when these condition will met, then this 100 rupee will be taxable, right? So Karthik, will you pay 100 rupee? Will you pay tax on 100 rupee in this year?
No, sir, after 5
No,
years.
no, you will not. But Karthik, when you receive this 100 rupee in the current year or after 5 year?
In the current year.
Current year. So you received 100 rupee in the current year, but it is going to be taxable after 5 year. Is it creating any temporary difference? Answer is yes.
Yes.
It is creating a temporary difference. Yes. So, and this temporary difference will lead to taxability in future. Karthik has received 100 rupees today, but Karthik has to pay 100 multiplied by 30% tax, 30 rupee tax. Not today. He has to pay after 5 years. Means this temporary differences is creating a liability for future. Why? Because this temporary differences is going to be taxable in future. So that is why, my dear friend, if it is creating an obligation to pay in future, will it be a liability or asset?
Liability.
Liability. That is why, Karthik, it will leads to a liability, right? Not DTL is a temporary difference. No, not DTL is a taxable temporary differences. The taxable temporary differences is creating a deferred tax liability. Is that clear? Why I am
Yes.
stressing and focusing? सर बात तो वही है, लेकिन आप इस पे क्यों इतना स्ट्रेस कर रहे हो, क्यों इतना फोकस कर रहे हो? ये आपको दो जगह पे हेल्प करेगा लाइफ में. कहां कहां पे करेगा? Where it will help you in your life? Number one, sitting in the examination hall. Number two, sitting in the interview room.
Interview.
Yes, it will help you at two places, right? Where people wants to judge you, where people wants to evaluate you on your core concepts. ओके, जैसे मैंने बोला ना कि बीट इन्वेस्टमेंट प्रॉपर्टी बोलो, पीपी बोलो, द आंसर वुड बी सेम, बट आंसर इज नो. इट इज आस्किंग अबाउट द प्रेजेंटेशन, एंड देयर यू गॉट डिफिटेड. Depreciation is the same only. Deferred tax will be the same only. But the only difference is whether you're writing investment property or writing PP. Okay. So if a temporary differences is creating a taxability in future, it will be DTL. But if the temporary differences is creating a deductibility in future, like you remember our first example of provision for gratuity. In the first year and second year, we paid higher taxes. Why? That provision for gratuity was disallowed. What happened in the third year? So you have seen, na, in first year and second year, you paid a current tax of 15,000 rupees. But what happened in the third year? You paid a tax liability of 9,000 rupees only. Correct? So it means this temporary differences, these temporary differences of provision for gratuity is creating a recoverability in future, is creating a tax deductibility in future, tax recoverability in future. So it means deductible temporary differences will create a deferred tax asset, right? Deductible temporary difference will create a deferred tax asset. So once you are okay with the book base, once you are okay with the tax base, you understand it is a deductible temporary differences or taxable temporary differences, you know the tax rate, right? 25%, 30%, whatever it will be, right? Then you need to create, you need to compute, and you need to recognize your DTA and DTL. You will recognize your deferred tax asset and deferred tax liability, DTA and DTL. Okay? Clear? Yes.
Yes, sir.
Yes, sir.
Now quickly, we will quickly discuss this detailed example along with the computation and presentation, right? Then we'll take a break for 10 minutes. Then we'll come to the detailed and complex questions. Okay? Are you enjoying the class?
Yes, sir.
Yes, sir.
Yes. Are you finding the method is right? First, I'm explaining this entire, I'm just revising this entire chapter, and then I'll come to the questions. Yeah.
Yes, sir.
And of course, during the revision, I'm also picking those small questions so that you will have a conceptual clarity around it. ABC Limited has following transaction in place for FY 24-25. Compute the carrying amount, tax base, type of temporary differences, DTA, DTL, etc. for the books of accounts for ended on 31st March 2025. The company has invested rupees 8 lakh in mutual fund during the year. The fair value on the reporting date is 8.5 lakh. Quickly tell me, what is my carrying amount? 8 lakh. What is my
8.5.
8.5 lakh? My carrying amount. My book base is 8.5 lakh. What is my tax base?
8 lakhs.
My asset value is higher in books. What should I do?
Like create liability.
Create liability. If it is create liability, then Karthik, if it is liability, which nature of difference it is?
So taxable temporary
Taxable
difference.
temporary differences, right? So mutual fund, what is the nature of the item? Mutual fund is an asset. Carrying amount 8.5 lakh, tax base 8 lakh. It is creating a taxable temporary differences. And what is the temporary difference? 50,000 rupees, right? Tax rate. What is my tax rate? My tax rate is given my tax rate, and on the tax rate also, the question is saying tax rate is 30%. However, the government has announced a tax rate of 32% for the future year before 31st March. Will you take 30 or 32?
32, sir.
32% if the tax rate has been enacted or announced before 31st March. This deferred tax is for future. In future, you will get a benefit of 32%, not 30%. Right? Right? So 32% is your tax rate. It will create a DTL. And what is your DTL amount? 16,000 rupees is DTL amount. The value of machinery purchased is rupees 1 lakh in the beginning of the year. Life is 10 year. Income tax WDV 20%. So 1 lakh rupee gross block, 1 lakh rupee cost, 10-year life. What is the carrying amount? What is the book base?
90,000.
90,000. What is the tax base?
80,000.
What should I
80,000.
do? In my books tax, in my books asset is higher. What should I do?
Reduce the asset.
Create liability.
Yes, reduce the asset means create a liability. Okay. So which nature of difference?
Taxable.
Taxable temporary difference. Okay. So asset 90,000, carrying amount, tax base 80,000, taxable temporary differences, difference is 10,000, 32% tax rate, DTL 3,200. Okay. Third question. The income received in advance. The income received in advance. Just a minute. The income received in advance from the customer for rupees 50,000. Income received in advance. Okay. In income tax, income is taxable in the year of receipt. So advance income received. Income received in advance. What is the nature of item? What is the nature of item?
Liability.
Income received in advance is a liability. Karthik, what is the accounting entry for income received in advance? Bank account debit
Bank
to
Bank user advance income.
advance income liability. Okay.
Yes, sir.
So liability value is 50,000
Yes.
because it is received in advance. So in your books in your books of accounts, the carrying amount of this liability will come at 50,000 rupees. What happens in the tax base?
So zero, it's nil.
Zero.
0.
Why? Nothing
So
is carried forward. Nothing is carried forward because this is taxable in the year of receipt. In the year of receipt. Okay. So basically, in this case, your liability is 50,000 in your books, but your liability is zero in your tax. So liability is higher. What should you do?
so make an asset.
Reverse
Asset.
liability. Reverse liability means make an asset. Make an asset. Simple. So my income received in advance, advance from customer unearned revenue liability, 50,000, tax base zero. So if it is an asset, deductible temporary differences, 50,000 is the difference, 32%. Your DTA is 16,000, right? The company has created a provision for gratuity of rupees 1 lakh. In Income Tax Act, this is allowed only on the payment basis. What is your carrying amount of liability? 1 lakh. What is your tax base?
Zero.
0.
0. So your liability is higher in the books. What should I do? Reduce
Reverse
liability
liability.
means make an asset.
Create
Simple,
asset.
right? Same. Okay. Yes. Now the next one is, so interest receivable. I'll not discuss this. The company has incurred preliminary expenses. Which sections talks about preliminary expenses? इनकम टैक्स में कौन सा सेक्शन है?
35 था शायद.
35D. 35D. Okay. So preliminary expenses for rupees 1 lakh during the year. In income tax, 1/5 deduction will be allowed in every year. The company has incurred preliminary expenses of rupees 1 lakh during the year. In income tax, 1/5 deduction will be allowed in every year. Tell me, what is the carrying amount?
Carrying amount is 0.
0.
Sailendra, what is your view?
Same, sir, because there is no changes.
No changes, okay. Hmm. Any other? Any other participant? So Rajat is answering offline. Rajat, what's your view? Rajat is also saying your book base is 0 and tax base is 1 lakh minus 20,000. 80,000 is the tax base, right? Yes, friends. The concept of preliminary expenses does not exist in the accounting books. When I'm saying does not exist in the accounting books means the preliminary expenses has to be charged to P&L in the same year. There is no provision of carry forward and amortizing over a period of 5 years. What is this 1/5? 1/5 is 1/5 means whatever expense you have incurred, you are amortizing over a period of 5 years, right? In Income Tax Act. But in Companies Act, in Ind AS, in accounting standard, this amortization of preliminary expenses is not allowed. It was there 10, 20, 10, 15 years back, but now it is not there. So whatever preliminary expenses are there, it has to be charged to the P&L in the current year itself. So what is the book base? What is the value of the asset and liability? 0. There is nothing which is going to be carried forward. Right, Sailendra? Now, talking about Income Tax Act. So the company has incurred some preliminary expenses in the current year for rupees 1 lakh. What will be the accounting entry? Preliminary expenses account debit to bank account. What will be the accounting entry in the Income Tax Act also? Preliminary expenses account debit to bank account. But at the same time, this preliminary expenses will not be debited. This preliminary expenses will not be debited by 1 lakh while the bank will be credited by 1 lakh. This preliminary expenses in the current year will be debited by 20,000 and the second leg will be prepaid preliminary expenses 80,000. So what is the value of the asset in your tax base?
80,000.
What is the value of the asset in your book base? Carrying
0.
amount 0. So asset 0, tax base 80,000. What should I do? My asset is lower in company's books. It is 0. What should I do?
Increase the asset.
Increase the asset means create a DTA.
DTA.
Create a DTA. Yes, DTA. So this question was, many times students make a mistake. They thought that preliminary expenses is something which has to be debited in the P&L on 1/5 basis. No. It has to be debited in the year of expense itself. So the carrying amount of preliminary expenses is 0. Whereas in the tax base, as per the provision of income tax, 1/5 is allowed to be carried forward. Right? Sorry, 1/5 is allowed, 1/5 is allowed, and the remaining has to be carried forward. Okay. So are you 100% okay with this concept of carrying amount? I mean to say book base, tax base, temporary taxable temporary differences, deductible temporary differences, then your DTA, DTL. Are you okay with this entire concept? Yeah.
Yes, sir.
In your balance sheet, on few item there is asset. On few items there is a liability. Will you show the DTA DTL balances separately, or after netting off whatever is the final resulting balance that you will show in your balance sheet?
After netting off.
After netting off. It is after netting off, yes. Like in this case, net defer tax, net defer tax asset is coming 54,000. This is what you have to present. So, and in the notes to accounts, how you will show it? Items on which DTA is there, deductible temporary differences, right? These are the items where the deductible temporary differences are there. Okay. So carrying amount, tax base, temporary differences, DTA, DTL. This is how the presentation needs to happen in your notes to accounts, right? You have to show the carrying amount, you have to show the tax base, you have to show the temporary differences, you have to show the DTA, DTL calculation. Okay, right? So friends, we have covered the majority of the concept of DTA, DTL except your specific cases. We'll quickly cover the specific cases also after the break. And before that, we will cover few complex questions. Okay. So it's 8:32 now. Can we have a 10 minutes break? We'll start at 8:42. Okay.
Yes.
We discussed that no DTA detail to be created in the case of permanent difference, right? For example, Income Tax Department imposed a penalty on ABC Limited for rupees 10 lakh during the financial year 24-25. If a penalty has been imposed, whether this expense has to be recorded in the P&L or not. Of course, it has to be recorded in the P&L. It is part of your company's books, right? But what is the income tax treatment? Whether this income tax treatment, whether this penalty is allowed in the income tax books.
No, sir, not
No,
allowed.
it is not allowed, right? So it is a permanent difference while this penalty is payable, right? The order has come, the penalty is payable. The liability is there, carrying amount is there, but the tax base, what about the tax base? The tax will not allow this. It's a permanent difference. It's a difference. The tax base is zero. It's a difference, but permanent difference. Okay. So DTA DTL will not be created. Unused tax losses and credits. Carry forward losses. DTA has to be recognized on unused tax losses and unused tax credits when it is probable that future taxable profit will be available against which such losses can be utilized. Right. And most of the time, the question used to come on this aspect. For example, the company has a taxable loss of 10 crore in FY 24-25. The company is probable that it will be able to generate taxable profit in FY 25-26 for rupees 4 crores. So how much is the taxable loss? 10 crore. And how much company is expecting to generate in the next year? 4 crore. From FY 26-27, the company will go in tax holiday period for 10 years. Considering company is operating in the gift city of Gujarat, where government has given a tax holiday period of 10 years to be opted by the company. Tax rate is 30%. Advise the treatment of deferred tax in the books for FY 24-25. Yeah, Karthik, what should we do here?
So we should consider the losses up to 4 crores only and then create the taxable differences on that.
Why, Karthik? Why not on the remaining 6 crore also?
So because it is not probable to reverse those 6 crores in the future.
Why? Because the company is going to the tax holiday, right?
Yeah, that's right.
But the tax holiday is only for 10 years. So after 10 year, when the 10 year will complete, of course, this company will start earning. Yeah, am I audible now? Yeah, Karthik. So once this tax holiday period is over, then the company will earn profit and these losses will be adjusted from those profits. That's the remaining 6 crore.
Sir, as per income tax, the profit cannot be carried forwarded for more than 8 years.
Yes.
So
So
it will not be.
basically, yes, you are absolutely right. Basically, these remaining unused tax losses, which is 6 crore, it cannot be reversed in future in the given time frame as per the allowed time frame. And hence, the company is probable to recover only 4 crore rupees of losses. And that is why, in this case, the only 4 crore loss can be utilized in the tax holiday period. there will not be any taxes and hence no question of utilization will arise. The remaining unused carry forward tax loss will be lapse. Hence, DTA will be recognized only to the extent of the profits which the company is probable to utilize. So DTA is equal to 4 crore multiplied by 30%. Second question. The company has a taxable loss of 10 crore in FY 24-25. The company is probable that it will be able to generate taxable profit in next 5 years, aggregating to 8 crore by implementing a tax planning strategy. The cost of implementing the tax planning strategy will be rupees 50 lakhs. Tax rate is 30%. Advise the treatment of deferred tax in the books for FY 24-25. So what information is given? 10 crore is a taxable loss in the current year. And company is probable that the company will be able to generate a profit of 8 crores by implementing a tax planning strategy. They have hired a different chartered accountant. They have hired Lavanya. She is a chartered accountant. She is a tax expert, and the company hired her. And after her advice, the company believed that yes, we will be able to earn a taxable profit of 8 crore in the next 5 years. And she is charging 50 lakh rupee. The cost of implementing this strategy is 50 lakh rupee, let's say. So standard says that DTA will be recognized to the extent it is probable that future taxable profit will be available. In case of tax planning strategy, DTA will be recognized to the extent of what? Taxable profit arising from tax planning strategy net of the cost of implementation. So in this case, what is my net amount? 7.5 crore. So this company will recognize the deferred tax asset only to the extent of 7.5 crore. When I say deferred tax asset means 7.5 crore multiplied by tax rate is equal to deferred tax asset, right? This is the accounting. Is that clear? This is one of the question which is there, illustration number 7, which we did, right? So I'm not touching on this. Now talking about the business combination, quickly we'll do this question and then we'll move to a similar question which is given by ICAI. Deferred tax treatment in case of business combination. Have you guys covered business combination? Have you revised business combination? Yeah.
Yes, sir.
Have you heard about acquisition method, fair value approach?
Yes, sir.
Yeah. So how the acquirer will do the accounting in case of business combination? Acquirer will
He
pay
will
the
recognize.
consideration.
Yes, sir.
Acquirer will pay the consideration. The consideration has to be measured at fair value, right?
Yes, sir.
Then minus fair value of net identifiable assets. Net assets means you have to do a fair valuation of assets and liabilities. If there is any non-controlling interest, then you have to add back your NCI also. Consideration transferred plus non-controlling interest minus fair value of net assets is equal to your goodwill
Goodwill.
or gain on bargain purchase. It is your goodwill or gain on bargain purchase, correct?
Yes, sir.
So now the question comes is, let's say, when the company, the acquirer is fair valuing, when the acquirer is fair valuing the assets and liabilities of the acquiree, right? So is there any deferred tax implication on that? That is the question from the Ind AS 12 perspective. Have you covered this part in Ind AS 103? Yeah?
Yes, sir.
Yes, sir.
Yes. So friends, what happened in accounting standard? In AS, the book value approach was used in accounting standard. So whatever is the book value in the books of acquiree, that will become the value in the books of acquirer. So basically there was no question of arising, no question of accrual of deferred tax asset or liability, right? But if I talk about Indian accounting standard, if I talk about Ind AS 103, so the value in the books of acquiry will become different in the when it reaches to the acquirer. So there is a difference. The value which is sitting in the balance sheet of acquiry and the value which is absorbed by the acquirer. So when this temporary differences is happening between the carrying amount and the fair value, what is the deferred tax implication on this value? Let me talk about that. So in case of business combination, the deferred tax will be created on the difference between fair value of the net assets and the carrying amount of the net assets acquired. And the carrying amount of the net assets acquired. Example, A Limited has acquired following assets and liabilities lying in the books of B Limited as at 31st March 2025. The carrying amount and the fair value arrived at the time of acquisition is as follows. Particulars: building, machinery, bank balance, trade creditors, deferred tax liability. There is already a deferred tax liability. Since it is acquiry balance sheet, तो deferred tax liability भी तो होगी. This deferred tax liability in this carrying amount, this deferred tax liability represent what? It represent what? It represent the
Tax payable in the future period.
yes, it represent the carrying amount. It represent the difference between the carrying amount and the tax space in the books of acquiry, right? Okay. So then this building which was 50 lakh valued at 80 lakh, machinery which was 30 lakh valued at 40 lakh, cash and bank same value, the creditor same value, the deferred tax liability same value. Okay. So A Limited has paid a purchase consideration of rupees 150 lakhs. Compute deferred tax asset and deferred tax liability and goodwill on this acquisition. Tax rate is 30%. Purchase consideration paid 150. Net assets acquired: building at fair value, machinery at fair value, bank balance at fair value, trade creditors at fair value. What about deferred tax liability? What about DTL? See, this building carrying amount was 50 lakh, right? यही था ना, 50 था ना? It has become 80, right? This building carrying amount was 50 lakh, okay? And let's say, let's discuss this scenario with the help of a different example here. Let's say this building was 50 rupee, tax base is 40 rupee. So what will be the DTL will be there? So DTL will be for 3 rupee, right? So in this case also, in the acquiry balance sheet, there is a automatic a DTA or DTL must be there in the acquiry balance sheet. There is an automatic DTA DTL. Why? Because of the difference in the carrying amount in the tax base. After acquisition, what happened? This 50 is valued at 80. This 50 is valued at 80, right? So the 50 rupee of building has been fair valued at 80. It is fair valued at 80. Now tell me, just doing a fair valuation from 50 to 80, whether tax base will change. In the income tax provision, whether this tax base will also change.
No, sir.
Income tax department will say that I know only the cost price. I don't know about this fair valuation concept. In my books, it will be 40 always. You guys do whatever you want to do. So in the same situation, tell me, when this 50 becomes 80, so how much is the difference between the carrying amount and the tax base after acquisition? The difference become 40, right? Earlier, what was the difference? 30, no? Sorry, earlier the difference was 10. Now the difference is 40. So this difference is increased by 30. Okay. Earlier the DTL was 3. Now the DTL will become 12. So this DTL has to be, an accounting entry has to be passed for 9 rupee of DTL. So what happened, basically what happened, whenever there is a fair valuation, fair value of the net assets versus your carrying amount the net assets of the acquiree, on those temporary differences multiply by the tax rate, your additional DTA and DTL will come, right? On the fair valuation of the net assets acquired. So in this case, my DTL will be how much? My DTL will be 17. How this 17 has come? Fair value of the net assets excluding DTL. Fair value of the net assets. What is my fair value of net assets? 130 minus 15. My fair value of net assets. Okay. Then my carrying amount of the net assets excluding DTL. 90 minus 15. What is the difference? 40 is the difference. What is my tax rate? 30%. 12 is my deferred tax liability. DTL already created 5. DTL additionally created 12. What is my total DTL? 17. So this DTL will be 17 and this is my fair value of net assets acquired. Goodwill has to be 52. So goodwill has to be created after creating your additional DTA or DTL. Is that clear? Is that clear to everyone? Clear है या नहीं है? Is it clear in mind or clear from mind?
Clear, sir.
Yes. Now let's
Clear.
discuss question number 2. Question number 2. I hope this question number 2 is visible in the Word file. Should I zoom it?
Yes, sir.
Is it visible now?
Yes, sir, visible.
Yes. Question number 2. On 1st April 20x1, A Limited acquired 12 crore shares representing 80% stake in B Limited by means of a cash payment of rupees 25 crore. So this company A Limited acquired this A Limited acquired 30% stake. And what is the purchase consideration? 25 crore. Okay. And how much shares they have acquired? 12 crore shares. It is the group policy to value the NCI in subsidiaries at the date of acquisition at fair value. It is the group policy to value the NCI in subsidiaries at the date of acquisition at fair value. Okay. To value the NCI in subsidiaries at the date of acquisition at fair value. So NCI, there are two approaches to NCI. Na? What are the two approaches to NCI under Ind AS 103?
Fair value approach and the proportion of net assets approach.
Yes, proportionate interest in net asset method and the fair value approach. And they have decided to go for the fair value approach. Okay. The market value of an equity share in B Limited at 1st April 20x1 can be used for this purpose. And on 1st April 20x1, the market value of B Limited share was 2 rupee. Okay. On 1st April 20x1, the individual financial statement of B Limited showed the net assets at 23 CR. Okay. So in the first paragraph, it is talking about the purchase consideration. It is talking about the 80% acquisition. It is talking about the fair value approach of NCI. It is talking about the fair value of the shares of B Limited. Okay. Yeah. Then it talks about the net assets of 23 crores. Now, the directors of A Limited carried out a fair value exercise to measure the identifiable assets and liabilities of B Limited as on the acquisition date. Following matters emerged. They decided to fair value. Property having a carrying value of 15 crore on 1st April had an estimated value of 18 crore on that date. Means, what is the increase in the value of the property?
3 crores.
So it means the carrying amount which is there in the acquirees books, this carrying amount will go up, right? This carrying amount will go up, correct? This in this 23 CR, this 3 CR will be added, right? This 3 CR will be added. यही होगा ना? Fair value, what is my fair value of net assets? 23 plus 3, 26. Because 15 is already included in this. So I should include 18. So I should increase 3, right?
Right, sir.
Plant and equipment having a carrying value of 11 crore had an estimated market value of 13 crore at that date. So 2 crore has been increased in the plant and machinery also. So 3 crore in the property, 2 crore in the plant and building, 3 to 5 crore. Okay. Inventory in the books of B Limited is shown at a cost of 2.5 CR. So in this 23 CR, it is 2.5 CR. Fair value of the inventory on the date of acquisition is 3 CR, 50 lakh. So 5 crore 50 lakh. This has to be added by 5 crore 50 lakh. Okay, 5.5 crore. The fair value adjustment. The fair value adjustment have not been reflected in the individual financial statement of B Limited. So basically in the individual financial statement, they have shown this net assets at carrying amount, which is cost methods. Okay. So this fair value adjustment has not been reflected in this 23 CR. So what will be the value of this 23 CR? क्या वैल्यू हो जाएगा 23 CR का at the time of acquisition?
28.5.
28.5. Okay. In the consolidated financial statement, the fair value adjustment will be regarded as temporary differences for the purpose of computing deferred tax. Okay. The rate of deferred tax to apply to temporary differences is 20%. Assume that the current book value prior to fair valuation exercise equals to the tax base. क्या बोला इसने अभी? What is the meaning of this paragraph? Whether Lavanya or Karthik, will you help me understand this line? I'm not able to understand this line. Can you help me understand this line?
Sir, current book value, which is 23 crores, we need to consider it as tax base for calculating temporary difference.
Means there is no temporary difference between this 23 crore on this 23
Yes.
crore, right?
Yes,
This is
sir.
what this question is saying. So question is saying whatever is the carrying amount, that is a tax base also. That is what the question is saying, right?
Yes. Yes, sir.
यही बोल रहे हो आप? Okay.
Yes, sir.
Understood. So basically same value is the carrying amount and the tax base. Same value is there. But after the fair valuation, whether things will change after the fair valuation?
Yes, sir.
It will change. Okay. So what will be the change? What will be the change?
There will be DTL or DTA because of the difference.
DT and DTL because of the difference. Yes, DT and DTL. Okay. So on this 5.5 crore, since the value of the asset is increasing by 5.5 crore, so will it be DT or DTL?
DTL.
DTL. Okay. So 5.5 crore multiply by 20% will be your DTL. Okay. So calculate the deferred tax impact above and compute the goodwill arising on acquisition of B Limited. This is the question, right? So this question is a mixed question of Ind AS 103 and Ind AS 12. So how will you do that? So let me tell you. Friends, if I talk about this thing, computation of net assets of B Limited, as per books, 23 CR, and we will add 5.5 CR of fair valuation impact. My fair value of net asset is 28.5 CR. But the moment I'm increasing my asset by 5.5 CR, this is giving me additional liability also in terms of deferred tax liability, right? And what is my deferred tax liability? 5.5 CR multiplied by 20%, 1.1 CR. So what is my fair value of net assets acquired? 28.5 minus 1.1, 27.4 CR. 27.4 CR, right? What is my goodwill? My goodwill is, what is my purchase consideration? What is my purchase consideration? You
25
remember
crore.
25 CR? 25 CR? Company has acquired 80% stake. This company has acquired 80% stake. This company has acquired 80% stake. And what is the value of, what is the number of shares of that 80% stake? 12 crore.
12 crores.
Today I'm facing some difficulty in my network connection. Am I audible? So, Karthik, am I audible now?
Yes, sir.
Yes, sir.
Okay. So, acquirer has acquired 80%. If 12 crore is 80%, what is 100%? What is 100%?
15.
15 crores.
15 crore. So, 15 crore is my total shares. 80% I have acquired. So, NCI share is what? 20%, right? So, 3 crore
Yes.
pertains to NCI. And what is the fair value of the? Yes, Lavanya.
Yes, sir. 2 rupees.
And what is the fair value? Fair value of the share is 2 rupee. So 3 crore multiplied by 2 rupees, 6 crore. So my purchase consideration is 25 crore. My NCI is 6 crore. My total is 31 CR. And my net assets at fair value is 27.4 CR. What is my goodwill on the acquisition date? It is 3.6 CR. 3.6 crore is my value of the goodwill. Right? Any question on this question? Any question?
No,
Is
sir.
that clear to everyone? Yeah. This question we have also covered in our full class. This question we have covered in our full class. Okay. Right. So let's do another question. Let's do another question. And this question I want to take from this illustration number 8. A Limited recognizes interest income in its books on accrual basis. However, for income tax purposes, the method is cash basis. On 31st December, it has interest receivable of rupees 10,000. The tax was 25%. On 28th February, the finance bill is introduced in the legislation that changes the tax rate to 30%. The finance bill is on 21st May 2002. Discuss the treatment of deferred tax in case the reporting date of A Limited's financial statement is 31st December and these are approved for issue on 31st May 2002. Is this question clear? The question talks about the interest income which is accrued on accrual basis. Means it has to be received later on. However, income tax only considers cash basis. On 31st December, it has interest receivable of 10,000 and tax rate was 25%. On 31st December, tax rate was 25%. But on 28th February, what happened? The finance bill was introduced in the legislation which is changing the tax rate to 30%. But this finance bill is enacted. This finance bill is enacted on 21st May 2002. And you need to discuss the treatment of deferred tax in case the reporting date of A Limited was 31st December but these are approved on 31st May. Tell me whether you need to take 25% or 30%. What should you do?
25%.
First of all, tell me on the reporting date. On the reporting date, what was the tax rate? 25%.
25%.
So this new rate was introduced. This new rate was announced and enacted post reporting date, right? This new rate was announced and enacted post reporting date, right? Not on or before reporting date. You remember the concept of adjusting and non-adjusting event, right? Ind AS 10, you remember that? याद है नहीं है adjusting
Yes,
event
sir.
non. So
Yes,
in
sir.
this case, if you see, this event is occurring after reporting date, even the event of announcement as well as enactment. So that is why you need to consider the rate which is prevailing on the reporting date. But what happened if this rate would have been announced before reporting date and enacted after reporting date? Then what happened?
Then we need to consider new rates.
Then you need to consider why, because evidence of condition was available on the reporting date, because the government has already announced in the budget that we will increase the rate by 5%, right? So it creates a constructive obligation in the mind of impacted parties. On the reporting date, we know that government has announced a higher rate. The only thing is, since government has announced a higher rate, so the only thing is, now if this rate would have been enacted, there are high chances that the rate would have been enacted. And if the rate would have been enacted before approval of the financial statement, it has to be considered for the purpose of deferred tax calculations, right? It has to be considered for the purpose of deferred tax calculation, right? But in this case, neither the rate was announced nor enacted before reporting date, as it and before reporting date, hence it will not be considered for the deferred tax calculation on the balance sheet date. Is that clear? Salendra, is that clear? Yeah. Sachi, is that clear?
Yes, sir, clear.
Okay. Now let me take you another question on this Word file. Just a minute. Question number 3. I hope this Word file is visible to all of you. Question number 3. Right. K Limited prepares consolidated financial statement to 31st March each year. During the year ended 31st March, K Limited entered into the following transactions. On 1st April 2001, K Limited purchased an equity investment for rupees 2 lakh. So if this company has purchased an equity investment, Karthik, what is the accounting entry in company's books and income tax books?
So investment in equity debit to bank.
Investment in equity debit to investments to bank, right?
Yes, sir.
The same entry in both the books?
Yes, sir.
Same entry or different entry in both set of books?
So same entry in both set of
Same
books.
entry in both set of books, because of course the investment has been purchased. So in the income tax books, investment will come in the as an asset, and in the company's books, the investment will come as an asset. Okay. The investment was designated as fair value through other comprehensive income. On 31st March, the fair value of the investment was 2,40,000. So this 40,000 has been taken into the P&L in the OCI. In the tax jurisdiction, in which K Limited operates, unrealized gains and losses arising on the revaluation of investment of this nature are not taxable unless the investment is sold. K Limited has no intention of selling this investment in the foreseeable future. So what is the need? What is the ask of the question? The ask of the question is explain and show how the tax consequences, current and deferred, of the above three transactions would be reported in the statement of profit or loss and other comprehensive income for the year ended 31st March. Assume tax rate to be 25%. What will be the answer for the question number 1? Tell. What should be the answer for question number 1? Tell me what should be the answer. What should be the answer of question number 1?
Sir, as there is no probability of selling, we won't create any deferred tax.
What you
So
said
the
as? First of all, tell me in this case, what is the accounting? What is the carrying amount of this investment? First of all, tell me.
2.4, sir.
2.4 lakh, right? 2.4 lakh. You have to apply the balance sheet approach. In your balance sheet, this investment will come at 2.4 lakh. What is the tax base of this investment? 2 lakh,
2
right?
lakhs.
2 lakh. Because in our Ind AS 109, the financial asset has to be fair valued. So my tax base is 2 lakh. My book base is 2.4 lakh. So is there a temporary differences or not? This is a temporary
Yes, sir.
difference, right? And what is the temporary difference is 40,000. So my asset is higher in my books of account. What should I do? I should create a
Create
liability.
DTA.
I should create a liability. Okay. So my liability would be 40,000 multiplied by 20%. I will have a deferred tax liability. Okay. The intention of the entity is not to dispose of this investment, right? So whether this entity will dispose or not dispose this investment, so this entity said that the K Limited has no intention of selling this investment in the foreseeable future. Will it affect your accounting? No. Foreseeable future means within 12 months. Foreseeable future means within 12 months. It does not just, this statement is given just to confuse you. It will not impact your accounting, right? So this investment is designated as a fair value through OCI, where your mark to market, where your unrealized gain will go.
OCI and
OCI.
OCI, unrealized gain will also go to OCI, right? Unrealized gain will go to OCI. So where the tax impact, the deferred tax, which we have seen, that it has to be a deferred tax liability, and deferred tax liability is 40,000 multiplied by 25%. 10,000 will be a deferred tax liability. So my question is, this 10,000, what is the accounting entry of 10,000 rupee? Deferred tax expense account debit to deferred tax liability account, right? So where this deferred tax expense of 10,000 will come, in the P&L or in OCI?
so in OCI.
Where it will come in the, so who said
OCI.
this? Which India says this?
So India's 109.
Index 109, 109 talks about that this mark to market for investment designated FEOCI will go to OCI. I am talking about tax. The tax related to OCI item has to go to OCI. Who said this? Where it is written? It is written in Ind AS 1. It is written in Ind AS 1. Right? Ind AS 1 says that the tax impact relating to P&L item has to be charged to P&L. The tax impact relating to OCI item has to be charged to OCI. Okay. Since it is an investment measured at fair value through OCI, the mark to market unrealized gain will go to OCI and related tax impact will also go to OCI. Right? Okay. So what is the answer of this question? Let's see the answer. Because the unrealized gain on revaluation of equity investment is not taxable until sold, there are no current tax consequences, because the question is asking you about current tax also. So there is no current tax. But the tax base of the investment is 2 lakh. Revaluation creates a taxable temporary difference of 40,000. This creates a deferred tax liability of 10,000. The liability would be non-current. Okay. The fact that there is no intention to dispose of the investment does not affect the accounting treatment, because the unrealized gain is reported in OCI. The related deferred tax will also be reported in the OCI. Clear? Shall I go to question number 2? B. On 1st August, K Limited sold products to A Limited, a wholly owned subsidiary operating in the same tax jurisdiction as K Limited, for 80,000. So K Limited sold the product to A Limited, which is a subsidiary of K Limited. Both are operating in India. Same jurisdiction. Okay. The goods, and what is the value? 80,000. Goods had cost to K Limited for 64,000. So K Limited sold goods for 80,000. The cost of the goods is 64,000. By 31st March, A Limited has sold 40% of these goods, selling the remaining during next year. So first of all, in the books of parent, the revenue was 80,000. The cost was 64,000. In the books of subsidiary, what is the cost?
80,000.
Subsidiary की books में cost क्या होगी? 80,000. In the books of subsidiary, cost is 80,000. But by 31st March, this subsidiary has sold 40% of these goods, selling the remaining next year. So in the first year end, the subsidiary has only sold 40% of the goods. Means if this parent will prepare the consolidated financial statement, how much are the goods which has already been sold out to the external parties? ये जो इंटर ग्रुप है, ये इंट्रा ग्रुप एलिमिनेशन तो हो जाएगा ना. If the parent has sold goods to the subsidiary has purchased from parent, receivable, payable, income, expense, whether this will be eliminated or not eliminated. This has to be eliminated now. Yeah, eliminate होगा ना? होगा नहीं होगा? Yes or no का आंसर तो दो.
Yes, sir.
Elimination has to happen between the parent and the subsidiary, and in this case, when parent has sold goods at 80,000, when parents had sold goods at 80,000 and the cost was 64,000, what was the profit has made?
16,000.
16,000.
16,000. 16,000. And the current tax rate is 25%. So what is my current tax liability? What is my current tax liability?
4,000.
4,000.
By 16,000 kamaya, 16,000 multiplied by 25%, parent has to pay a tax of 4,000 rupees. Right. Now let's come to the consolidated financial statement. The tax liability has to be computed. Current tax liability has to be computed at an entity level as per their standalone financial statement. Now coming to the consolidated financial statement. In the consolidated financial statement, what was the value? What was the cost of the inventory as a group? As a group, what was the cost of the inventory?
80,000.
64,000 as a group. As a group, it was 64,000.
Yes, sir.
A father has a 64,000 rupees of inventory. He has sold his son that inventory for 80,000. Right. So tell me first of all, what is the cost to the family for that inventory?
64,000.
64,000, na? So it is just like one that that money from one pocket is moving to the another pocket. So what is the first value? What is the cost to the family? The cost to the family is 64,000, right? And
Yes, sir.
out of the cost of 64,000, 40% of the goods have been sold to the third party. When I'm saying sold to the third party, means which is sold by the subsidiary to the third party. So what is the 40? What is the 40% of 64,000?
25,600.
25,600. So 25,600 worth of goods have been sold to the third party. Means how many goods in this family, how much is the value of inventory which is still lying in the balance sheet? 64,000 multiplied by 60%
28,400.
or 64,000 minus 25,600. So 38,400, right?
Yes, sir.
38,400. 38,400 worth of inventory is still lying in the consolidated financial statement. 38,400. So basically, now my 64,000 is the cost, 60% inventory is lying. What is my tax base of the unsold inventory? What is my tax base? What is my tax base? Tax department will say
8,000.
it is not 64,000, it is 80,000. Your value of the inventory is 80,000, right? So tax department will say, since you have sold this inventory to the subsidiary, the value of the inventory is 80,000. So your unsold inventory has to be 80,000 multiplied by 60%, 48,000, 48,000, right? So means you are saying my cost price of unsold inventory is how much? 38,400. Whereas tax department is saying 80,000 multiplied by 60%, which is 48,000. So your tax base is higher than your book base. So what is going to be created? Asset or liability?
Asset.
Asset.
Asset, your value of inventory in the books is lower than your tax base. So asset is going to be created. At what value? 48,000 minus 38,400. 9,600 is the temporary differences. 9,600 multiplied by 25%. So deferred tax asset of 2,400 is going to be created in this case. In this case, right? So let's see what is the answer which is given. Let's see. When K Limited sold a product to A Limited, the company K Limited would have generated a taxable profit of 16,000. 80 minus 64. This would have created a current tax liability for K Limited and the group of 4,000 rupees. 16,000 multiplied by 25%. This liability would be shown as current liability and charged as an expense in arriving at a profit and loss for the period. In the consolidated financial statement, the carrying amount of the unsold inventory would be 38,400. 64,000 multiplied by 60%. Whereas tax base of the unsold inventory would be 48,000. So why I am considering 80,000 as a tax base? Why? Because you are computing the deferred tax in the books of the parent, because consolidation has to happen in the parent entity, right? So the tax, since the parent has already sold out at 80,000, so the tax will say that the tax books will say that your value is 80,000 for the entire inventory because it has already been sold out. So whatever is unsold in the family, it has to be valued at 80,000 multiplied by 60%, right? In the consolidated financial statement, there would be a deductible temporary difference of 9,600, which is 38 minus 48, and a potential deferred tax asset of 2,400, which is 25% of 9,600. This would be recognized as deferred tax asset since A Limited is expected to generate sufficient taxable profits, against which to utilize the deductible temporary differences. Yes, the resulting credit would reduce the consolidated deferred tax expense in arriving at profit or loss. Is this concept clear or not clear? Sachi, is that clear? Yeah.
Yes, sir.
Second question is clear.
Yes, sir.
Lavanya.
Yes, sir.
Third question. On 31st October 20x1, K Limited received 2 lakh rupee from a customer. 2 lakh rupee received from a customer. Okay. And when it received on 31st October. This payment was in respect of services to be provided by K Limited from 1st November to 31st July. Means the payment has been received in advance. So what is the accounting entry, Sachi? The payment is received in advance from the customer. Bank account debit to advance from customer liability. Okay. On 31st October, right? K Limited recognized revenue of 1.2 lakh in respect of the transaction, in respect of this transaction in the year ended 31st March 2002 and will recognize the remainder in the year 31st March 2003. So 2 lakh rupee advance was received during the year, and during the year the revenue was recognized for 1.2 lakh. So what is my advance? What is my liability at the end of the year? What is my liability at the end of the year?
80,000.
80,000.
My liability is 80,000. Okay. So my carrying amount is 80,000. Okay. So then it says that under the tax jurisdiction in which K Limited operates, 2 lakh rupee received on 31st October was included in the taxable profit in that year only. See, if we prepare the books of accounts as per Companies Act, what is my revenue in the first year? What is my revenue in 2001 to
120.
120? What is the revenue which is considered by income tax department as per income tax provision?
2 lakh.
Entire
2
2.
lakhs.
They are saying that it will be taxable in the year of receipt. So they are considering the revenue of 2 lakh. We are considering revenue of 1.2 lakh, right? Both under company's books and under income tax department books, both we have received 2 lakh rupee. So we have received 2 lakh rupee. We recognize revenue of 1.2 lakh rupee. In our company's books of accounts, 80,000 is my value of liability. 80,000 is carrying amount. In income tax books, 2 lakh received, 2 lakh recognized revenue. What is the tax base in income tax books?
0.
0. So my liability in books of accounts, my liability is 80,000. In my income tax, liability is 0. So book base is 80, liability, tax base is 0. What should I do?
Reduce liability.
Reduce liability.
Create
Reduce
asset.
liability means create an asset.
For tax asset
So-
will be formed.
Yes, deferred tax asset will be created. 80,000 multiplied by 25%. 20,000 rupees of deferred tax asset will be created. I hope this question clarifies these three situations and you guys have understood these three situations very well.
Yes,
Have you
sir.
understood or you haven't understood?
Understood, sir.
Understood.
Understood? Now let's go to question number 4. Okay. Generally in your examination, when question will come, question will come in these form and shape. The question will come like a case study where the application of other standard along with Ind AS 12 will be there. Okay. Yes. Question number 4. I hope you can see the question number 4. Is it visible now?
Yes, sir.
It is visible. X Limited prepare consolidated financial statement to 31st March each year. During the year ended 31st March 2002, the following events affected the tax position of the group. Okay. Y Limited, a wholly owned subsidiary of X Limited. Y Limited is a subsidiary, X is a parent. Y Limited made a loss adjusted for tax purposes of 30 lakh. Who made a loss? Y. Y made a loss for 30 lakh rupee. Y Limited is unable to utilize this loss against previous tax liabilities. Okay. Y Limited is unable to utilize this loss. Income Tax Act does not allow Y Limited to transfer the loss to other group companies. Means if this Y Limited will earn profit in future, they can set off losses. Otherwise, this loss cannot be transferred to other companies. However, it allows Y Limited to carry the loss forward and utilize it against company's future taxable profit. The director of X Limited do not consider that Y Limited will make taxable profit in the foreseeable future. So what should we do? Tax rate is given. What is the tax rate which is given in the question? So tax rate is given at 20%. What should we do? What is the answer to question number 1? Y Limited made a loss of 30 lakh. It cannot transfer to other company. It can only offset, carry forward and set off the loss against its own future taxable profit. The director do not consider Y Limited to make a taxable profit in the foreseeable future. This is the question.
Nothing to be created, sir.
Sir, DTL should be created, no?
DTL?
No, sorry, DTA will be created.
See.
Sir, as there are no future foreseeable profits, nothing will be created.
Yes. So Sachi, while it is a deferred tax asset, yes, it is a deferred tax asset. Why it is a deferred tax asset? In the books of accounts, carrying value is nil. But in the tax base 30 lakh, tax department says that whatever losses you have incurred, I will allow you in future. Right? Means tax department is creating an asset in the tax books. This is a tax department which is creating the asset in the tax books, but company's books, no asset is created. Okay. So it is a deferred tax asset. This situation will give a deferred tax asset. But standard says that in case of carry forward losses and unused tax credit, deferred tax asset has to be recognized to the extent it is probable that the losses can be adjusted in the foreseeable future. Here, the question itself says that the directors are not certain that the profits will come in the foreseeable future. So in that case, till the time certainty will not arrive, this DTA on the carry forward losses will not be created.
Yes,
Right?
sir.
So in this case, no deferred tax asset to be recognized because there is no potential, no prospect of being able to reduce the tax liability in the foreseeable future. Why? Because few taxable profits are not anticipated. Question number 2. Just before 31st March, means just before the closing. Just before the closing, of year, X Limited committed itself to closing a division after the year end, making a number of employees redundant. Therefore, X Limited recognized a provision for closure cost of 20 lakh in its balance sheet as on 31st March 2002. Income Tax Act allows tax deduction for closure cost only when the closure actually takes place. In the year ended 31st March, X Limited expect to make taxable profit which are well in excess of 20 lakh rupee. On 31st March 2002, X Limited had taxable temporary differences from other sources which were greater than 20 lakh rupee. So the company has announced, the company has committed, they will close a division after the year end, but they have done this commitment to themselves that they will close a division after the year end and many employees will redundant. And hence X Limited has recognized a provision for closure cost of 20 lakh in the balance sheet. They have recognized a provision. Restructuring provision. Have you heard about restructuring provision? Concept of restructuring provision? In which standard you have heard about the concept of restructuring provision? Have you heard or not heard? Ind AS 37. In Ind AS 37 says that when the restructuring, so provision for restructuring has to be recognized when there is a constructive obligation, when there is a constructive obligation. Okay. So in this case, the company has recognized the restructuring provision of 20 lakh, but income tax department says that we will allow this restructuring provision only when the actual expense will be incurred, when the actual expense will incurred, right? When actual expense will incur. So tell me, the company has created a restructuring provision on 31st March 2002. What is the carrying amount of the liability?
20
20
lakhs.
lakhs.
Is there any carrying amount of asset? Is there any tax base of this liability?
No.
No, sir,
No,
zero.
because tax department is not considering this accounting entry. Tax department is saying, I don't know this accounting entry. Income company's book says that, Ind AS says that you have to create expense to liability, provision for restructuring expense account debit to provision for restructuring liability account. Income tax department says that I don't know this accounting entry. So if this accounting entry will not come, of course, your liability will not come. So first of all, liability book base is 20 lakh on 31st March 2002. The liability tax base is 0. What should I do? I should
Reduce
reduce
liability.
liability
So
means
create
create an asset. I should create an asset, deferred tax asset. So 20 lakh multiply by 20%, 4 lakh will be deferred tax asset. Now, what it says that in the year ended 2003, X Limited expects to make a taxable profit which are well in excess of 20 lakh. Which are well in excess of 20 lakh. So, in this question in 2003, what will happen? This expense of 20 lakh will be allowed in the year 2003 when?
Paid in actual.
When it is actually paid.
When actually takes place.
When it is actually takes place. And question is telling you in the next year they have the sufficient taxable profit. They have sufficient taxable profit means the asset which you have created in the first year, deferred tax asset on this 20 lakh, it has a potential of reversal. Are you getting me? Yeah. So in this case, your deferred tax asset is required to be, your deferred tax asset is going to be recorded for rupees 4 lakh, right? So how this answer is framed? Let's see the answer. The provision creates a potential deferred tax asset for the group since its carrying value is 20 lakh and tax base is nil. This deferred tax can be recognized. This deferred tax can be recognized, okay, because X Limited is expected to generate taxable profit in excess of 20 lakh. In excess of 20 lakh. Okay. In the year to 31st March 20x3, the amount of deferred tax asset will be 4 lakh. This asset will be presented as a deduction from the deferred tax liability caused by the taxable temporary differences in the next year. Because in the next year it is saying, that X Limited on 31st March 2002 it is saying X Limited had taxable temporary differences from other sources which are greater than 20 lakh. So taxable temporary differences will give you deferred tax liability. So the deferred tax liability is more than 20 lakh. So deferred tax liability on the taxable temporary differences is on more than 20 lakh. So DTL is, let's say, 30 lakh. For example, DTL, the other sources liability is 30 lakh. So what is my DTL? 30 lakh multiplied by 20%, 6 lakh. I'm just assuming a number of 30 lakh. What is my DTA? My DTA is 4 lakh. So on 31st March 2002, your deferred tax liability is more than 20 lakh temporary differences. I'm assuming hypothetically a number of 30 lakh. What is my DTL on 30 lakh? If my temporary difference is 30 lakh, what is my DTL? 30 lakh multiplied by 20%, 6 lakh. What is my DTA on restructuring provision?
4 lakhs.
4 lakh. So what? How should I present? 6
Net
lakh
of
DTL, 4 lakh DTA, net. What is the number?
2 lakh DTL.
2 lakh. 2 lakh DTL is going to be presented. This is what this question is talking about. This question is saying this asset will be presented as a deduction from the deferred tax liability because of the larger taxable temporary differences. Is that clear? Clear or not clear? Sachi, is that clear?
Yes, sir.
Okay. Now moving further, question number 3. Question number 3. During the current year, during the year ended 31st March, X Limited capitalized development cost which satisfied the criteria in paragraph this of intangible asset standard. The total amount capitalized was 16 lakh. So what is the crux of the story in this 2.5 line? The company has capitalized a development cost in intangible asset for rupees 16 lakh. The development cost began to generate economic benefit for X Limited from 1st January 2002. So 1st January in the next year. And we are talking about year ended 31st March 20x1. The director of X Limited estimated that the project would generate economic benefit for 5 years from that date. And they are saying the future economic benefit will be received for 5 years. From that date, matlab from 1st January 2002. The development expenditure was fully deductible against taxable profit for the year ended 31st March 2002. And what they are saying, this development expenditure was fully deducted for the year ended 31st March 2002. Tell me, what is the accounting impact in terms of deferred tax? So friends, first of all, if I talk about this deferred tax, the capitalization value was 16 lakh rupee, right? And we are talking about 31st March 2002. What is the carrying value of intangible asset on 31st March 2002? What is the carrying value of intangible asset?
12.8
How come it is 12.8?
after providing for depreciation.
So, Lavanya, this asset was capitalized. This asset was capitalized on during the year 31st March. Okay? The asset is giving a future economic benefit starting from 1st January 2002. And director also said that the life is 5 years from the time they started giving a future economic benefit. Okay. So in the year 31st March 2002, this asset has given a future economic benefit only for 3 months. The life was started. See, when we talk about research and development now, when it is saying development cost has been capitalized, it means you keep on adding your development cost into the asset. But when the asset is started giving you future economic benefit, you estimate your life. Okay. So the life has been started from 1st January 2002. So in the year 31st March 2002, we will charge depreciation only for 3 months. 16 lakh is my value of the asset. 5 year is life. So 16 lakh divided by 5. What is the value? First of all, what is my per annum depreciation?
3 lakh 20.
3 lakh 20,000. If 3 lakh 20,000 is for a year, what is the value for a quarter? 3 months?
80,000.
80,000. So what is my carrying value of intangible asset on 31st March 2002? 16 lakh minus 80,000.
15 lakh 20,000.
15 lakh 20,000. 15 lakh 20,000. What is my tax base? What is my tax base?
0.
Why 0?
Entire amount is allowed as deduction.
Why my tax base is 0? Yes, my tax base is 0 because in the question it is written, the development expenditure was fully deductible against taxable profit for the year ended 31st March 2002. Means 16 lakh was completely charged to P&L in your income tax P&L. So in my book base, 1520 is the value of intangible asset. In my tax base, 0. What should I do?
Reduce the asset.
Reduce the asset. Reduce the asset means, Sachi, what is meant by reduce the asset? Create a liability. Deferred tax liability.
Yes.
Deferred tax liability, right? So what is my deferred tax liability? My deferred tax liability will be on what? my deferred tax liability will be 1520 multiplied by 20%. 3,04,000 will be my deferred tax liability. Okay. Right? Clear? Not clear?
Clear, sir.
Yes, sir.
Now, the question number 4. The question number 4 of question number 4. Okay. On 1st April, X Limited borrowed how much? 100 lakh rupee, 1 crore. The cost to X Limited of arranging the borrowing was 2 lakh rupee. My incidental cost is 2 lakh rupee. And this cost qualified for a tax deduction on 1st April 2001. So this 2 lakh rupee can be charged to P&L in income tax P&L. Right? Income tax provision says that I will allow you this 2 lakh rupee of cost like stamp duty or whatever, cost which you are incurring on the arranging this loan. The loan was for a 3-year period. No interest was payable on the loan, but amount repayable on 31st March 2004 will be 1 crore 30 lakh 43,800. This equates to an effective annual interest rate of 10%. As per the Income Tax Act, a further tax deduction of 34,3800 will be claimable when the loan is repaid on 31st March 2004. Yes. First of all, tell me, what is the carrying value of the loan on the day 1? Tell me. Day 1 पे क्या होगा?
One crore plus 2 lakhs, sir. 1 crore 2 lakhs.
1 crore plus 2 lakh or 1 crore minus 2 lakh?
I mean minus 2 lakhs.
1 crore minus 2 lakh. Okay. So number 1, the net receipts. So the bank has given you 1 crore and bank has collected 2 lakh rupee on account of cost. So what is the net amount you got from the bank?
98 lakhs.
98 lakhs. 98 lakh is the base amount. Okay. On the day 1. On the day. So because in accounting books, your Ind AS 109 says that your incidental cost needs to be netted off from the loan amount, from the financial liability, and you need to compute the interest cost on the basis of effective interest rate method, EIR method. Income tax says that we don't know EIR. Okay, Income Tax Act says that first of all, whatever loan amount you have taken, that is your liability. It is not 98 lakh, it is 1 crore. Okay, it is 1 crore. Second, Income Tax Act says that we don't know EIR. Whatever interest you will pay, we will give you deduction. Right? But Ind AS says that EIR. And in this question, the loan, what is the period of the loan?
3 years.
3 years is the period of the loan. In this question, 3 years is the period of the loan. Okay. And what is my EIR?
10%.
10%. So on the day 1, what is my value of the loan on the day 1? What is my value of financial liability in my accounting books?
98 lakhs.
98 lakh. And your EIR, effective interest rate, is 10%. So how much interest you will recognize in the first year in your accounting books?
9,80,000.
9,80,000. What is your carrying value of the loan at the end of the year?
88 lakhs 20,000.
What is your carrying value of the loan at the end of the first year? At the end of the first year,
107.8.
1 crore 7,80,000. How it will come at a 1 crore 7,80,000? Your 1 crore, then 1 crore was the amount which you have taken. 2 lakh you have refunded as a cost. 98 lakh you net you have received plus interest portion. 98 lakh multiplied by 10%. You remember the interest has to be payable at the end of the tenure. 3 साल के बाद तो ऐड होता रहेगा ना लावण्य?
Yes, sir.
Yeah. So 1 crore 7,80,000. But what is the tax base? So carrying value of the liability is 1 crore 7,80,000 at the end of the first year. But what is the tax base of this liability? 1 crore. Because income tax department is saying that I will allow your tax, I will allow your interest expense only in the year of payment. I will not pass any accounting entry for interest. Second, for me, your loan amount is 1 crore. 2 lakh I have given you deduction. So 1 crore 7,80,000 versus 1 crore. What should you do? Your liability is higher in the books. What should you do? Sachi, what will you do? Your liability is higher in the books. You will create a deferred tax asset. Reduce liability means
Asset will be created, sir.
create an asset, right?
Yes.
On 7,80,000 multiply by 20%, 1,56,000 rupee of DTA will be created, right? This is the answer of this question. So friends, we have covered 3-4 questions from ICAI. This question which is given by ICAI and 6-7 examples and question, right? From my own Excel file and the other example as well, right? So more than 10-11 questions we have covered today. In addition to the concepts, right, which I have covered in my detailed class, I have covered in this class also, right? So thank you so much. I hope you have enjoyed the session. I hope you have understood the session very well. If you have any quick question, I will answer to that. If there is no question, I can conclude the session. Let me know if you have any question. Any question? Karthik? Lavanya, Sachi? Any
No
question?
question, sir. We'll revise your concepts once more. Sir, you will share this file on the portal.
Yes, yes. I will share to Board of Studies. Board of Studies will share with you.
Sure, sir. Thank you.
Thank you. Ashokji, session over.
Thank you, sir.
Thank you.